Every single day, trillions of dollars change hands, flashing green and red numbers just darting across the screen. But what's actually happening behind that glass? Well, welcome to The Explainer. Today, we're taking a pretty fascinating journey from the abstract mechanics of the stock market right down to the operational heartbeat of a corporate behemoth. I'm your host, and we are going to bridge the gap between financial theory and physical reality. We hear about the stock market constantly, right? But it can often feel like this distant digital game of numbers. Today, we're firmly grounding those numbers in reality. So, let's dive right into this by asking the absolute most fundamental question every investor should ponder before they click buy. What exactly are you acquiring? Is it just a fleeting digital blip, or is it something far more substantial? It's crucial to remember that behind every single ticker symbol is a living, breathing organization. To figure that out, we'll start with the macro blueprint of the market machinery, decode a real annual report, look at the staggering scale of a giant, unpack the 6 capitals framework, and finally, see how they innovate for the future. Let's jump in.
Starting off with part 1, the stock market machinery.
When you step back and look at the big picture, the market really isn't just a casino. It's a meticulously designed engine. According to Zeroda's foundational modules, you've got regulators acting as the strict guardians of the capital markets, setting all the rules of the game. And right below them, market intermediaries and complex clearing and settlement operations are working completely invisibly. Think of these clearing operations as the hidden digital plumbing that ensures your money and the seller's shares actually swap hands securely and instantly. This entire ecosystem exists simply to facilitate the flow of capital to where it can be put to work.
And this perfectly maps out the lifespan of an investment. You take a business from its initial quiet funding origins to going public and finally trading on the secondary market minute by minute. You know, a company starts with private funding stages, relying on a really small pool of early believers. But eventually, to reach massive global scale, it has to tap into public funding through an initial public offering, or IPO. This is the exact moment the retail investor is allowed to enter the story. Once that happens, those shares trade continuously on the secondary market, reacting in real time to corporate actions, consumer trends, and macroeconomic events.
Moving right along to part 2, decoding the annual report.
Now it's time to transition from our market telescope to our corporate microscope. When you buy a share, you aren't just buying a ticker symbol. You're buying into physical factories, immense revenues, and tangible environmental impacts. The annual report is the ultimate translator here. It takes those abstract rules of stock trading and translates them into the highly physical, day-to-day realities of a corporate giant. Today, we're using Hindustan Unilever's 2025-26 annual report as our lens to see exactly what that public capital actually builds out there in the real world.
Which brings us to part 3, the scale of a giant.
To truly grasp what it means to be a publicly traded titan, we have to comprehend sheer scale. Get a load of this number, over 9 million. That's how many outlets HUL reaches across India. They support this massive physical footprint with Shikar, their proprietary digital B2B ordering app that is already onboarding roughly 1.4 million retailers. This isn't just a distribution network. It's the frontline machine your investment capital fuels, ensuring that no matter where a consumer is, the product is literally within arm's reach.
And flowing through that massive distribution network are 50 distinct brands spanning 15 fast-moving consumer goods categories. Whether it's home care, beauty, personal care, or foods and beverages, these are products designed to meet the diverse, everyday needs of Indian consumers. You're investing in household relevance. We're talking about the soap in your shower, the tea in your mug, and the detergent in your laundry room. And to satisfy that relentless demand, they produce an awe-inspiring 85 billion units across the 26 owned factories. To put that into perspective, that's enough products for every single person on Earth to have about 10 of them. No way, right? To maintain that mind-boggling volume with absolute precision, they even rely on 5 highly advanced AI-powered lighthouse factories. The vast physical infrastructure required to churn out over 85 billion units is precisely why companies need those capital markets we discussed earlier.
Now, all of those physical units translate into a massive financial weight. A staggering turnover of over 63,000 crore rupees for the 2025-26 period. This is the heavy financial reality behind that fluctuating stock ticker on your screen. A robust distribution footprint and massive production capacity directly result in these monumental revenue numbers and a net worth of over 49,000 crore rupees.
Let's shift gears to part 4, the 6 capitals framework.
Analyzing a modern stock is about way more than just looking at the financials. It's about evaluating a holistic ecosystem. Notice how deeply interconnected these capitals are. Financial and manufactured capital cover the money in the factories, the stuff we traditionally measure. But a company absolutely cannot survive without intellectual capital, which at HUL includes over 800 scientists driving breakthrough innovations. Then you have human capital, constantly upskilling the workforce to be future-ready. And finally, social and natural capital, ensuring the business actually gives back to the communities and the environment it so heavily relies upon. You literally can't maximize the first two without nurturing the other four.
Investors today really have to balance traditional financial metrics against modern environmental and social imperatives, a dynamic HUL actively manages. While traditional analysis focuses heavily on that 63,000 core turnover and direct return on investment, modern investing requires looking incredibly closely at ESG, environmental, social, and governance metrics. Why? Because long-term profitability fundamentally requires long-term sustainability. If you run out of natural resources or lose the trust of your community, your financial capital is going to inevitably collapse. This means paying close attention to things like HUL's 100,000 plus tons of potential plastic waste diverted from landfills, or the 12 million individuals benefiting from their community interventions. You can see this social and natural capital at work in the real world, from empowering rural women to sustainable tea sourcing and protecting fragile natural environments. Initiatives like the Profit Program build deeply sustainable communities around their manufacturing sites, proving that corporate giants aren't just abstract financial entities. They are deeply embedded in the social and ecological fabric of the regions where they operate.
And that brings us to our final section, Part 5, Innovating for the Future.
To maintain this massive, sustainable machinery, a company has to constantly innovate to stay ahead of the very market we learned about in the beginning. Take HUL's new Advanced Liquids Lab of the Future, operating in Mumbai since November 2025. They're using AI and robotics for rapid prototyping and generating zero dark data, meaning absolutely no piece of experimental data gets lost or goes unused. Every single bit feeds back into the AI to make the next experiment smarter. This facility allows scientists to prototype formats like body washes and laundry liquids at 6 times the scale of manual batch making. That is intellectual capital operating at maximum velocity to capture shifting consumer demand.
And this innovation extends right onto the factory floor with digital twins of manufacturing operations. Think of this like a highly advanced video game simulation of their exact factory operations. It allows them to predict scale-up challenges in a virtual space before they even happen in the physical world. By creating these digital replicas of factory equipment, they completely eliminate the need for costly physical factory trials. It's a stunning example of using data and technology to drive extreme cost efficiency.
Ultimately, this combination of high-tech production and deep sustainability commitments is what drives their long-term growth engine. They're aggressively pushing forward with 5 nanofactories to accelerate innovation. They're ensuring a 97% deforestation-free supply chain. They're engaging in vital community water stewardship like the Suvida program. And they're strategically deploying their financial capital for bolt-on acquisitions of science-backed brands like Minimalist and Oziva. It's a comprehensive, relentless, future-fit strategy designed to keep the engine running for decades.
So, as we wrap up this explainer, I'll leave you with this thought. When you hit that buy button, are you just acquiring a piece of market data, or are you funding a complex, living ecosystem? The next time you log into your trading terminal or look at an index, remember the 9 million retailers, the AI-driven labs, and the community initiatives that actually power those flashing numbers. Keep learning, keep analyzing those annual reports, and I'll catch you in the next one.